Hey, it's Monday, November the 14th. Pretty quiet day today. Volume was quite lower, much lower than average, and the range was very small. It's probably a good thing. It gets the market is digesting the big gains over Thursday and Friday last week. So a little pause is not a bad thing. Let's just hopefully it's a pause and we head back up. Let's take a look at the charts here. The S&P. So those two nice moves on Thursday and Friday. We opened this morning slightly down, came up, just barely took out the high on Friday, but then had a really bad close. In the last 45 minutes, it sold off. I'm going to say fairly hard, but it wasn't a big range day, but closed right near the bottom. So just shows that this 200-day moving average is going to be a hard nut to break through, which, as you can see, if you look at Toronto, I had some drawing stuff in there I'll take out. It hit there and then has rejected it, but we'll see. It might work its way through. But back to the S&P. What's got me a little nervous is, and I'm always nervous, right? If you look at this move here back in June through to mid-August, nice move up. But it was accompanied by a decline in volume, which just suggested that the institutions were not participating in this move. This is more retail investors, probably a lot of short covering, thinking this was the real bottom down here, and then it put in a slightly higher low. So people that were short are now starting to cover. So that's my guess on that. Then as the price came down from August into the low in mid of October, look what happened with the volume. The volume was increasing. And these big skyscrapers were all red, which is just a footprint of institutional selling. So the institutions were more interested in unloading their positions than they were loading up. And that had a big weight on the market. So now we've come to this position. We had this this massive day here, where we opened way down here, we gapped down below, but then all of a sudden a wave of buying came in and we closed right near the high. And that was on October the 13th, and on big volume. So to me, that just suggested the institution said, okay, I'm done selling. I'm going to start buying. There's some bargains here. Although when you look back on it, a lot of this was what I call junk buying. These were stocks that were really beaten down, like Amazon and Facebook and even Apple and a lot of the other high flyers, Upstart, Unity Software, and a few things like that were up bigly, but they were already down 80% for the year. So a lot of buying in that kind of crap. And then we had this, but anyway, this move back up has been accompanied by more or less average volume. But there's been a couple of big days. This was what IBD calls a follow-through day, where you had more than normal volume and price closed more than 1.3% above the previous day's close. So we had one there. Then we had another one 3 days later, another follow-through day. And then we had another follow-through day on last Thursday, where price closed much higher on bigger volume. So there is signs that the institutions are now starting to whet their appetite a little bit. But I get pretty nervous when we're getting in this area here. So for any of you that are still somewhat invested, I think I've been talking about you could be 25% invested, maybe as much as 50% if you're an index investor. I would be I'd have some stop losses prepared. So if we go from here to take out this level, this little level here, that's about a 7% drop from here. And that's more than I can tolerate. And it probably should be more than you can tolerate too. Now, it's not to say that that's not going to go hit that. If it comes down there, it could bounce right back up again. But I'd rather be safe than sorry, because if it takes out that, we come down to this low, we could take out that, as I've talked before. When you look at the weekly chart, this is a picture that suggests this kind of action. So, you know, this, if history repeats itself, we go with something like this before we bounce back up again. So, and that's what we want to protect ourselves against. I mean, for what I've been preaching for so long is preservation of capital is far more important than return on capital. And the odds, the probabilities of this just, you know, ripping higher from here and going up back up to all-time highs, that's not, as to me, as probable a scenario. I don't think we're going to do this. I think we're going to come down into here somewhere and then find a bottom and then start heading back up. But it's going to be a long process. Anyway, that's my 2 bits worth, and that's how I'm managing my stuff. Currently, I'm only 7% invested, 93% in cash. I have 3 tiny positions, none of which did very well today, but they haven't hit my stops yet, so not too concerned. I am about 50% invested in ETFs, looking at, but they're doing actually quite well. This is a biotech index. In here at 54, I think it's 54.80 is my entry. I took some off, half of it off on Friday on this nice move, selling into strength. And my stop is now break even. So this is about a 10, I'm up about 10% on that position. So that worked out well, working out well. The German ETF I bailed on the last couple of days as it got up to this 200-day moving average, and this thing is headed like, it's not just sloping sideways, it's straight down. So I think I got all I could get out of this thing. I got very lucky. I don't know why I'm buying anything that's below its 200-day moving average. Why I bought it in the first place, I have no idea. It's not very smart, but it worked out to be about a 13% gain. So that one's closed out. HXU is a double ETF for the Toronto Stock Exchange. I'm in here, way down here. I took some off here for just because I'm chicken. I took some off on Thursday, and I only have about a quarter position left with a stop that's now down here. So I'm going to give this a fair bit of breathing room. I think this works out to be about so it comes down to my stop, yeah, about 6%, which is more than I might normally give it. But I want to give this some breathing room, and and if things do work out and head back up, I'll be adding back to this. A new position added today was the regional banks, and this was a dumb entry. I was looking at the chart incorrectly during the day, and I got a little anxious on this thing. This is still sloping down, although it did cross over. The best entry would be the same price I paid, which was $65. But if it gets that high tomorrow, that would be a buy. I've just increased the risk of this going down. If I'd bought it, if you buy it tomorrow at $65, there's a lot higher probability it's going to keep on going and not stop out. So this was a poorly timed purchase. And then yesterday I also bought the healthcare ETF in here, had a nice gap up this morning and a nice move up, although it had a very poor close. My stop was down here about 3% away, but I've since raised it to the 200-day moving average. So it'll still be about a 2% stop. So that's about it for for my comments for tonight. Like I say, if you're holding on to positions that are trading below the 200-day moving average, I would give them very, very short leash, especially since we've had a nice move up. Maybe 5%, put a stop loss at 5%, but because nothing really good happens underneath, if the stock is underneath this 200-day moving average. So I would be inclined to be very cautious with those. Okay, that's it. Have a great evening, and maybe have another video tomorrow or the next day.